Call to order the City of Santa Barbara's Finance Committee meeting for December 11th. Is there anyone in the audience that would like to speak to anything that is not on our agenda? And seeing no one, we'll go to the first and only item on our agenda, which is the 2018 fiscal year comprehensive annual financial report. Mr. Samario?
Yes, I'll start. Thank you, Mr. Chair and members of the committee. Bob Samario, Finance Director. We're here to present the comprehensive annual financial report for the year ended June 30, 2018. It's unlike the budget, the CAFR doesn't get a lot, or we call it the CAFR, it doesn't get a lot of visibility or publicity, but it's an important document for us, and it really represents a big work effort on the part of our accounting staff that starts in July and finishes today. So this is an important date for us, and our accounting staff are going to be relieved once today is done. They spent a lot of time on putting this together. Jennifer, as you can see, she's smiling because she doesn't have to be over here. She was relieved of doing some of the work. Lynn Sparks, to her left, is the accounting supervisor. She was the primary person in putting this together, along with her staff as well. So we have Mark Sewell today. He's our new accounting manager, so he did step in and was able to contribute a significant amount to putting this together and leading the staff. And then we have, I think you met Rich Kikuchi. He's a partner on the engagement. This is their final year, by the way, on the contract. We're going to be doing an RFP, and we've had LS&L for about 7 years now, so it's time for us to rotate through. But I wanted just to recognize the staff, Jennifer for her contribution this year, but also in prior years, Lynn and her staff, and Mark for what he did this year. Again, a lot of time and effort to produce a document that is important in representing our financial health. I wish it got more publicity and visibility, but that's just the nature of the beast. And with that, I'll turn it over to Mr. Sewell.
Thank you, Mr. Samario. Mr. Sewell?
Thank you, Chair Hart. So as Bob said, I'm Mark Sewell. I'm the accounting manager. New in role for 2 months, so bear with me. It's quite a large document to take you through, so hopefully I can pull out some of the main highlights and give you some good information. So I'll begin with the outline of the presentation. A few slides in terms of the background, explaining what this report is, explaining some of the layout and contents that you'll find, pulling out some of those key financial highlights for the fiscal year 18, and then some of the required disclosures that the city needs to provide to explain some of those numbers. And then Mr. Samario is going to talk about reserves, and particularly focusing on the general fund. And then finally, we'll have a partner from our current audit firm come up and give their opinion on these results as reported. So the background, what is the Comprehensive Annual Financial Report? It's prepared in accordance with National Accounting Standards, and it presents the financial conditions of the city as a whole and for all the individual funds. It's a consolidated report. It's comprehensive because it touches on so many aspects of the performance for the city, and we actually go over and above some of the requirements and have been recognised consistently from the Government Finance Officers Association for the quality of the reports that we put together. Why do we do it? Well, we have to. The city charter requires us to prepare this report, as does state law. And as Mr. Samario said, while it doesn't necessarily get the same heat and light as the budget process, it is a very important document in terms of representing the financial health of the city. And when the city then looks to raise finance, a lot of those banks and brokers will want to review the comprehensive report and just see take the temperature of the city. How will it be able to afford any debt repayments and the like? And it also does communicate to all the stakeholders of the city, council members, citizens, business owners, employees, what is the financial health of the city. So it's quite a large document, and it starts with an introductory section. We have a letter of transmittal that's prepared by the city administrator and the finance director, sets the scene in terms of the general aspects of the city and what the report's going to do, and the information about how the city is organised. Not every city is the same, and so we obviously make an attempt to explain what the city of Santa Barbara is and what it does. Then there is a comprehensive financial section, which is covered by an audit opinion. So this is where the third-party audit company will come in and review our financial records and provide opinions as to whether they are matching with the required standards and reflecting the city in a true and fair light. And we have some notes to those statements again, because sometimes you need some context to the numbers. And then finally, a statistical that's a mouthful, a statistical section, which again is unaudited, which gives some more trend information that explains more context of 1 year in terms of the light of the history. So with regards to the financial highlights, the report is split into a number of different sections, and we review the financial performance in a number of different ways. We have government-wide statements, where there's an attempt to try to show the city's performance in a similar light to you would in the private sector, where you would include all of the long-term liabilities and assets as well as the short-term assets and liabilities. And then we report on individual funds, and of course the general fund is one that gets a lot of focus. We do also have some information around our disaster funds and our water fund, and then I wanted to pull out and share with you some changes to our self-insurance fund and other post-employment benefits. And then I've also in this presentation be pulling out a bit more information in terms of a couple of key disclosures. One is the modified approach for city streets infrastructure. Of course, with the recent passing of Measure C and the increased ability to maintain our streets, that's an important measure. And then, of course, pension liability is something which is pretty important for most municipalities. New this year from the GASB board, the Government Accounting Standards Board, is statement number 75, which requires reporting entities to establish the present value of other post-employment benefits. These will be things like sick leave, retiree medicals, other things which are outside of pensions, and to calculate those through various means and quite complicated actuarial studies, and to require cities to value that and include it within their financial statements and performance. So that was new this year, and you'll see in a future slide that there was actually a prior year adjustment to bring the accounting standards into line with the new pronouncement, GASB 75. So I'll commence with the government-wide statements, and I've also, in each of these slides where appropriate, I've included a page number for the document itself. You don't have to go to those pages, but if you wanted to refer to them, there'll obviously be more information in the report itself than will be on the slide. But that's hopefully going to be a little helpful thing as we progress through the presentation. So what you see before you on this slide is the total city position as at June 30th, 2018. And if I just start at the bottom right-hand corner, my mouse will show me here, we go. The net position of the city is $787 million, with that being the difference between the assets and the liabilities for the city. And this slide breaks those two items into government activities and business type activities. And so throughout the report you see these consistent terms, and we'll explain what type of things the city does as they fit into those categories as we go forward. A breakdown of the government-wide statements. So this makes an attempt to break down all of the activities that the government does into the different types of activities such as administration, public safety, public works, community services, community development. And these are activities which are generally paid for by general taxes. There are no discrete service charges for a fire call out or PD going to a service call, for example. And what it shows as a takeaway here is that expenses far exceed the revenues for those departments because, as I say, they're generally supported by general taxation. The performance of the government-wide state programs for this fiscal year in 2018 actually reduced its net position by $2.4 million. And that's the bottom number I'll give you right here. However, as I mentioned before, with the new GASB pronouncement, statement number 75, that was impacted by this adjustment here of 7.5 million, which underlying meant that actually government-wide activities improved its financial position in fiscal year 18 by $5 million. But because we are now required to report other post-employment benefits within the balance sheet of those activities, we report it as the net position decreasing from 338 to 336 million. Okay. When we look at the same type of table for our business type activities, this then gives you a slightly different view, because as you can see from our business type activities of water, wastewater, solid waste, these tend to be our enterprise funds. In most cases, the revenues received by these functions and programs exceeds the expenses for those programs. And you can see here, water, for example, saw revenues in fiscal year 18 of just over 56 million, with expenses of 45 million, therefore a surplus of 11 million in terms of its operations. And you can run your eye down the table and you can see that the total of all of the business type activities resulted in revenues in excess of expenditures of just under $12 million. There are other general revenues that have come through as well in the fiscal year, resulting in a change in net position of $14 million for our business type activities. So again, an enhancement in the position, the financial position of the city with regards to its business type activities. If we then draw our attention to some individual funds, the general fund being one of the largest funds we have in the city. This slide here attempts to show you the balance sheet for the general fund and accounts for all of the short and long-term assets and liabilities. And I'll draw your attention to the number here towards the bottom right-hand corner, which has a total fund balance of $32.8 million. That, in essence, is the difference between all of the assets within the general fund and all of the liabilities within the general fund. Doesn't mean that it's available cash to go and spend on things, because these categorizations here within fund balance help you to understand, okay, of that 32 million fund balance, how much of it really is assigned or restricted to other things? And you can see that we have these categories here which are required reporting fields, and the vast, vast majority of this is restricted or committed. And those will be things like encumbrances, where there's a contract in place. How did we get there? Well, we budgeted the general fund to have an ending fund balance of $32,004,000, and we ended the fiscal year with a fund balance of $32,800,000. So we did exceed the budget in terms of the performance for the general fund. And there are some additional points that we'll make later in the presentation where Mr. Samario will go into more details in terms of what does this mean for the general fund reserves against policy. Okay, so this is related to that, but it's not the whole picture at this stage. But I just want you to know that the general fund had a better financial performance than was budgeted. I'm sorry?
So I just wanted to point out that Mr. Sewell spoke to the variance between budget, but you could see the middle column, the actual column, that was, ignore the budget, which is a sort of a plan. How we ended the year in real terms is we had $133.8 million of revenues, but $137.5 in costs. So we ended the year with a deficit. We ended up consuming overall reserves of $3.7 million, even though from a budgetary perspective, it looked like we did okay. But in reality, we did consume reserves, and that's the part where when I get into talking about reserves and the status of where we are relative to policy, I'll get into some details about that. But, that's caused by Thomas Fire, other issues with sales tax collections and things like that. But it wasn't a positive year. It wasn't a surplus. This is one of the few times we've actually had this magnitude of a deficit, but I'll get into that in more detail later.
Okay, thank you, Mr. Murray. So then we'll move along to some other of our fund financials. That nicely teed up, thank you. So as Mr. Samario mentioned, there were some one-off and hopefully one-off and unique events which occurred within the fiscal year which this report is speaking to. And so a decision was taken to create additional funds to be able to capture and monitor some of those costs. And so included within the city's position at this point in time is a negative fund position of the three disasters, the January and the February storms and the Thomas Fire. I'm sorry, the years are wrong on here. I would need to go back and adjust those. That was 17 and 18, of $2.6 million. And it's our expectation that the vast, vast majority of that will be reimbursable. Just at the timing where we cut off of this reporting period, it wasn't received and therefore wasn't able to be accrued and as revenue. And in addition to that, there's an additional $1.3 million of other costs in other funds, primarily the general fund, that again, we're confident that with agreements that already exist and with the FEMA reimbursement process, the city should be able to get reimbursement for the vast majority of those costs. Moving forward, one of our business type programs, water. On a previous slide, I showed you where the revenues were in excess of the expenses for this fiscal year in question, fiscal year 18. This is a view of its position, again, in its fund balance. And you can see that the water department has a fund balance of $172 million. It's a very large department within the city. And just pulling out some of the key stats in here, has over $300 million of assets, of which the majority of it is capital assets, and it does have $56 million of cash. And so the water fund, from a financial standpoint, in terms of its position, has improved. And if we look at some of the reasons why it's improved, then we can see that the sales revenues have increased from prior year by $6 million, representing an increase in sales, and some price increases for some customers. And within the operating expenses, they are coming in under the revenues, and so that leads to a change in net position of just under $13 million. So some of the expenses came in under budget and under expectation due to some timing differences with the desalination plant. So there were some very large costs associated with the building and the operation of that plant, and so therefore any delays in turning the machine on would save operating costs and debt refinance and all that, and debt costs and all that kind of stuff. So they're kind of a one-time expense saving, which we wouldn't expect to see ongoing in future years. And then the impact that then has to the water fund reserves is that an improvement in the water fund reserves, because excess of revenue versus expenses washes down into the reserves. And so the water department is at the end of fiscal year 18 reporting just under $40 million in reserves. And that will help them to tackle a lot of the backlog of capital and exceptionally high costs they have to operate the water department. Another of our individual fund financials, as I mentioned earlier, the changes to how we now must report post-employment benefits. Well, this is shown within the city's statements within two funds, and they cover slightly different things, but they are attempting to value today the actuarial valued liabilities for either accidents which may occur through workers' compensation or general liability, which would be shown in the self-insurance trust fund, or for some of the contracts we have of our employees for post-employment benefits, such as sick leave or retiree medical. And you can see that the net result of all of this is actually that there's a negative fund balance of $31 million. Now, that doesn't mean that the city needs to write a check for $31 million in the short term. It basically suggests that, you know, the liabilities that the city has due to the contracts it has in place and the risk profile of operating a city of our nature with streets and police and fire and everything like that, that over the course of the long term, that the city may well have the need to pay an amount such as that out. And that number changes over time as actuarial studies change and assumptions change. So again, it's a number that we are required to report, but a lot of it can be seen as a little theoretical because it depends on everything happening in the same way that the assumptions are made over a very long period of time. Yeah.
Couple comments. This is kind of like the third year in a row with respect to the self-insurance trust fund where we've seen our history of claims, both on workers' compensation and liability, general liability claims, be trend to the negative, more unfavorable. And so what that translates to is that when the actuaries come out, they suggest or they tell us what we should be having in terms of monies to fund those liabilities. And under GASB rules, we're required to record that as a liability. So you could see On that column of numbers, first column numbers down toward the bottom, the estimated claims payable for self-insurance relating to workers' comp claims and general liability claims is $14.4 million. 5 years ago, that was more in the $6 million range. And because of the history we've had in the last few years, which we thought initially were just anomalies, are proving to be more of a trend. We're hoping at some point this sort of tails off, but at this point we have that much in claims and we don't have enough assets to cover that. So you can see the number at the very bottom of that column shows a deficit of $5 million. That's our our fund balances. That's the difference between what we're supposed to have in terms of assets to cover those liabilities and what the liabilities are. So we have a substantial deficit that we're going to have to address. I point that out because as we go into the budget process, you'll hear us talk about the need to catch up and address that deficit. We're not going to run out of cash today. We have enough to kind of pay the claims over the next 3 to 5 years, but we're getting thin, and we want to make sure we don't get further behind because it's harder to catch up. So we're going to be recommending as part of the budget process additional funding toward that fund. Post-employment benefits, we'll get into that in a moment, but $26 million represents how much we're supposed to have today in cash or other assets to pay the liabilities that are going to be due long-term. It's sort of this funding model that says any point in time you should have a certain amount of money. It's like building a college fund. When your child is 10 years old, you should have a certain amount so that you're making progress toward getting fully funded funding by the time they hit 18. We are $26 million where we should be, and we're not nearly there. But we recognize that, and you'll see part of that is a much more theoretical obligation we have that Mark will talk about that we have no intention of ever funding because it's so theoretical, but under GASB rules, we're required to disclose it, and now for the first time, actually book it as a liability on our financial statements.
Councilmember Friedman?
Thanks for that clarification. And just, you mentioned that 5 years ago, the trend was about $6 million per year. So if in the future that does go down, then that $26 million would be adjusted too, correct?
Yeah, the Council Committee Member Friedman, the number to the left, the $14 million is the one we're talking about under self-insurance. So we see reduced claims going down for workers' comp or liability, that number will drop. The $26 million is a number that's going to change over time based on assumptions, as Mr. Soul indicated, but it's going to be about that number for a long time. There's nothing that's going to change that unless we decide we're no longer going to provide retirement medical benefits to our employees or sick leave at termination or those kinds of things, some of which are vested rights, some of which are not. And another one, as you will hear, is allowing our retirees to participate in our group insurance plan with their preferred rate. That's part of this number, this calculation. But unless we change what we're providing in terms of benefits, it's going to be a number that will continue to probably grow or at least be stable over time. It won't go down because it's not related to claims, unlike self-insurance claims.
Okay, thank you. So moving on to some of the key footnote disclosures then. So the modified approach for city streets infrastructure. There's certain accounting standards which allow the city to not charge any depreciation and go ahead and capitalize all the streets, so long as these streets are maintained to a certain objective criteria. And that objective criteria is the pavement condition index, and that's comparable across any location. And the city must have a pavement condition index of at least 60 to enable us to account on that in that fashion. So in essence, what we would do is any money we spend on maintaining streets would just be expensed through the books as an expense rather than creating assets and depreciation and all that kind of stuff. And unfortunately, at the end of fiscal year 17, the PCI had dropped to below 60 to 59. And so therefore, there was a challenge to the city's accounting process. And we were able to say, well, you know, we hope that there's going to be some additional funding for street maintenance, and there may be a ballot measure at some point for that. And lo and behold, within fiscal year 18, Measure C was passed by the voters and funds were allocated to street maintenance, and delighted to say that as at the end of fiscal year 18, the PCI score did increase not only from where it was, but to above 60 to enable us to maintain the accounting That wasn't the point of maintaining the streets, so that we could account in a certain way. It was a lovely byproduct. And of course, the intent is to continue to increase the investment in street maintenance with the hope that the PCI will continue to increase. And I've included in there a couple of numbers that, it's a roughly $15 million annual cost to maintain at 70. That's if you're already at 70. And so we've got to catch up some of that stuff. And within that, FY19's budget has allocated $19.7 million towards street maintenance. And in the past, that's been far, far lower, which is the reason why the PCI index had dropped. So just pulled that out. And then moving on to the pensions for the city, I wanted to share kind of what's changed and what's the current position. The city's net pension liability as at the end of fiscal year 18 is just over $330 million. That's the difference between the actuarial valued amount of money that the city needs to have for its current and current employees and future retirees as well as existing retirees. And I can show you that from this chart how it's changed over the years, that it's now just over $1 billion, the total pension liability for the city. And of that, the city has assets at a market value of just over $700 million, which then leaves the gap as what we call the net pension liability of $330 million. And the chart to the left, the pie chart, shows you how that breakdown of the liability happens. And so obviously PD and fire are 3/4 of the liability, with the miscellaneous employees 25% of the liability. And I'd just also like to point out one other thing, which is that the market value of assets isn't stable, goes up and down, but the market value did actually increase in fiscal year 18 compared to fiscal year 17. So that helped by $50 million, but the liability increased by even more. And one of the key reasons why the pension liability increased significantly so was the decision made by the CalPERS board to reduce their assumption on how much return they're going to get on their investments. So the discount rate, as it's called, dropped to 7%. And that has a significant impact in terms of the calculation of the liability. And included within the notes, within the report, is a sensitivity table that shows you if 1 percentage point of return differs, and it can be tens of millions of dollars. So that one assumption had the impact of over $30 million increase to the liability. Now, there are many assumptions that CalPERS take into effect, and smarter people than I put them into reports, and we have to report those numbers in our comprehensive report. So that basically leads to the position that where we were at 68.7% funded at the end of fiscal year 17, we're actually 68% now. It's gone down a little bit, even though the city's contributed more through PERS rates and the market value of assets has increased. The impact of the changes in assumptions has been greater as a negative impact to us. So the following charts kind of just break that down, and I won't spend the same amount of time, but I wanted to just show you where we are for each of the different plans. The city breaks them out. Miscellaneous employees are generally the administrative staff, the largest number of people. And you can see how the liability has grown over time. You then have the police safety plan, where again, similar story. And then the retirement fire plan. And so these all are subject to the same assumptions in terms of the discount rate that CalPERS expects to receive on its assets, yet each of the plans will have a different set of assumptions in terms of the benefits due at retirement and all the other actuarial assumptions that come into it.
So good news and bad news with this long term. Between now and 2025, what you'll likely see is those two bars becoming closer together. I think because of the changes to the discount rate and having the funding come from employer and employee contributions, which are more stable, that we're expecting to see is that we would have our plans being close to, if not fully funded, by 2025. That's the goal, in addition to some of the things that PERS has done to address with that shortfall, the current unfunded liability. On the downside is that the impact is to employers and employees and how we fund that, and that's going to be the challenge for a lot of cities. But again, the good news is that they're in a sense they're finally taking actions that are going to deal with the structural problem we have with unfunded liabilities and get to a fully funded status and create a more healthy plan, if you will, long term and beyond 2025. Then, with PEPRA kicking in, and we're going to expect to see rates drop, over a long period of time. We're not going to be seeing these ramp ups anymore. We're going to get there, and hopefully see them drop, which is good. It's just getting to 2025 is going to be a bit of a painful process, and for some cities, a very painful process.
Okay. So then, as we'd already touched on a little bit earlier about some of the other post-employment benefits, this is a breakdown of how that $26 million liability is sort of made up. The city does offer retiree medical benefits to employees who retire up until they become eligible, I believe, for Medicare at 65. And as Mr. Samario mentioned, the city also allows the retirees to be a part of the city's medical insurance program. And so the first two numbers you see there is the present value of that liability for offering the medical to those retirees, and then also what's determined as the implied subsidy, which in essence tries to value the fact that people who are older tend to have more expensive medical needs, and therefore has an impact on the premium that the city pays for its overall insurance policy. And then, so those two numbers combined, the liability of providing those benefits is just over $19 million in today's value. Not a year, it's just the recognition today of what that liability would be for all of employees. And then the last one on there being sick leave. This is where people have, depending on their MOUs, the opportunity to cash out sick leave based on eligibility requirements, and that then can convert into additional retirement benefits. So the $7 million that we report is today's present value of the likely costs for that within the future over a long period of time. And that's kind of what I mentioned, I suppose. Could have put this slide up and that would have been even more helpful. So then I'll now hand over to Mr. Samario, and he can give you some more detail in terms of the reserves.
Before we get to that, any questions at this point, Councilmember Friedman? Okay, thank you. Thank you, Mr. Sewell.
Sure,
Mr.
thank
Samario?
you. So, as you know, our policy requires, at least for the general fund, that we have two pots of money, one for natural disasters at 15% of the budget. And so the way we calculate the number is we look at the adopted budget for fiscal year 19, and we multiply that number, the operating budget, by 15%. We exclude capital in that, and that's the $20 million. And we do the same for the contingency reserve, and that's to deal with more sort of economic and unexpected events, $13.3 million. So what we're supposed to have in reserves per our policy is $33.3 million. We always put any monies we have first to the disaster reserve. That's the priority for us. So that's fully funded. Where we see any shortfall is in the contingency reserves when we do have that, and you can see it's about $2.3 million in shortfall. What I want to do is give you some context to that, because some of that is, we find, and we've learned more recently, has been created by several factors that are really timing differences that had they been realized at the time they should have last year, we would not be in the same position as we are today. So it gives me a little more hope to that. So we start with that $2.3 million, and some of the adjustments that I think are timing differences include the following. So there were, I'll start with the second one because that's probably the most significant one. When the Measure C went into effect April 1, and so that was the first quarter through June 30 of tax revenues we got. And we were well under budget. We assumed $5.5 million in revenues, just in line with what we get for a regular 1%. And we ended up getting closer to $4.2 million. And we weren't sure why. We thought that it was related to lack of compliance, where people just forgot to modify their point-of-sale systems to reflect the new 1%. What we've learned more recently is that, along with the other 1.1 million just below that, is that the state when they converted to a new system, they ended up having problems with that automated system, and they had to process the many, many tax returns manually, and they got very, very backlogged so that they weren't able to process them on time. And so, for example, on the $1.1 million, we got that extra money in late September or October. We ended up gaining, in addition to our regular quarterly returns or numbers, we got an extra 1.1 for the base 1%, and we also got another 1.1 from Measure C, which was, again, just because of lack of processing by the state. It didn't have to do with compliance. It had primarily to do with the fact that the state was just behind. So those, had they been received in 18 when they were due to us, would have had a much bigger impact or different impact on our year-end reserves. So for me, just to show, if we were to add those back, what does it look like? The $94,000 is a true up, and that is the true number, the true difference between what we budgeted in Measure C revenues and what we transferred over to our Measure C capital fund, that we're going to have to true up this year. We sent too much money over to our capital fund, $94,000 too much because of what we actually got after we adjust for this underpayment. So that's a small true up, but we're going to true that up, so that's not going to impact the general fund. It's sort of a temporary impact to the general fund. And then Mark alluded to the mutual aid. In addition to the $2-point-something million that we're tracking in a separate FEMA fund, which we always do, we're capturing all the costs that we know at some point will largely be reimbursed by FEMA and Cal OES. There were some other costs we incurred in the general fund that were not related to FEMA. They were more related to assisting other agencies under mutual aid agreements, the county, for example. So $765,000 we're expecting to get this year, but because of how we cut off our revenues and accruals, we couldn't count it as last year's revenue. But we will get that, so another timing difference. So in reality, we're looking at almost $3.1 million of reimbursements, revenues, or adjustments that really relate to prior year that we just couldn't recognize in the prior year because of when we got them. So on a restated basis, when I look at economically, how did we end the year last year? We did much better than we thought, and our reserves are in a much better position than we thought. But how we measure it on a CAFR is going to look differently. But I just wanted to indicate that we did end up better than we think. That's going to be represented in the CAFR, which is good news. So what we're going to end up with a bigger surplus this year than we had anticipated to offset the deficit last year. So over a 2-year period, we're going to be okay, at least for now, depending on how this year does. Any questions on this?
Thank you for that clarification. That's much better news.
Yep. Okay. All I had.
Okay. So just before we invite the partner from LSL, Rich Kikuchi, I just wanted to echo Bob Samario's comments that I'm extremely grateful as the new accounting manager for the support of Jennifer Tomacheski, who was doing double duty for a very long time, Lynn Sparks, the accounting supervisor, and then her team, Doug Smith, senior accountant, James Hamilton, senior accountant, and Margot Morello, accountant too. They've done a really, really good job. It's been a delight to work with them for the last couple of months, and I'm hopeful that next year is going to be just as successful. Thank you.
Thank you, Mr. Smool. Thank you, staff, too, for all your great work. This is a lot of documentation and time to putting all these numbers together and comprehensible reports that Mr. Kikuchi is going to talk about the audit of.
Good afternoon, members of the committee. My name is Rich Kikuchi, and I'm here on my annual trek up to Santa Barbara to kind of talk over the audit and the CAFR, and happy to be here. So LSL has been engaged to perform a financial audit and also to assist in the preparation of your comprehensive annual financial report. Now, we saw in a previous slide that the CAFR is it's a requirement that you prepare one by city charter. I think it's a good idea, even if it wasn't required by the city charter, just so you can see what the financial status of the city is. I have a lot of friends that are not financial minded, and sometimes, it surprises me that they don't know what their financial condition is. But the comprehensive annual financial report is just that. It gives you, as the governing board, just kind of a feel and an indicator of how the city finances are here at City of Santa Barbara, and we've talked quite a bit about that. So the CAFR really is a snapshot of your financial condition at June 30, 2018. And as your auditors, we're basically here as another set of eyes working with your staff just to kind of make sure that the amounts are materially correct. And in order to do that, we do a lot of testing. Of account balances, we look at your controls here, your processes, your policies that are in place, and just to give us assurance, and also to give you assurance that the system is working correctly, and that the amounts that are being reported in the CAFR are materially correct. So, as in the past, we've done a lot of work. It's a big document, as you can see, and a lot of work goes into it. And so we started back in the springtime, actually, towards the end of May. I had a team of about 4 auditors here for about a week, and at that time we do a lot of planning. We talk to a lot of people in a lot of different departments. We look at the documentation that we've had in prior years and make sure it's updated, make sure it's accurate. We look at the controls, and that's all done in order to help us plan the audit, plan the test work that we're going to conduct when we come back for what we call our year-end audit. And that took place in September and early October. We were here for a couple weeks. We looked at detailed. We did analysis in detail of various accounts. For instance, cash and investments is a big one. At home, I'll reconcile my checkbook every month, like I think everybody should do. And that's the same as a city. Every month you should reconcile your checking account, your cash and investments. And so we look at that to make sure that, everything looks accurate. We actually take it a next step and send out requests from your outside banks to make sure that the account balances reconcile to the statements. And so that's just kind of an additional type of test work that we do. That's just one example. We'll look at different account balances, say accounts receivables or your capital assets, your accounts payable, making sure that the expense and the liabilities, the revenues are actually recorded in their proper accounting period, because the statements are June 30, 18 statements. So, we want to make sure that if a check that was written in July, maybe that pertains to the following year, or maybe it pertains to June 30, 18. So we'll do various types of tests to make sure what the goods were for or the services that were rendered. That's just kind of a feel of some of the test work that we do. And the result is a comprehensive annual financial report. And so Mr. Sewell had talked at length about that. But as your auditors, you hire us basically so that you can have greater assurance that the amounts that we just went through are materially correct. We're basically another set of eyes. I think I talked about this last year as well, but the whole concept of reasonable assurance, we do a lot of test work. We spent a lot of hours here. We don't look at every transaction. We don't look at every dollar, but we look at, a lot of it, enough that we feel reasonably certain that the amounts in these statements are materially correct. And these are amounts that you can make management decisions on. It's going to assist you in your budgeting process next year. And so, that's the objective. And so it all gets distilled down to a one-page document. I'm not sure what page it's on in your CAFR, but it's our auditor's opinion letter. It basically says that we've issued what's called an unmodified opinion. What, you have the page on there? Page 9. So all our work was done so we could issue that one-page letter on page 9. The document really is the city's document that was spearheaded, and the team here put together. We assisted, but they're responsible for it. But that letter is from us, basically to you, saying that we feel that the amounts in this CAFR are materially correct. If we didn't, we would modify our opinion and say, for instance, there was this one large account balance and there was no detail for it. We couldn't test it. So that might be an indication that we might have to modify our opinion. But we tested all the account balances. We looked at the controls, and we felt comfortable with everything that's in this report. So that's what you want, an unmodified opinion. Other required communication letters, there are two, as in the past. The SAS 115 letter, internal control letter, a lot of people call it the management letter, and then your auditor's communication letter. So like I mentioned, in order to do the audit, we not only look at account balances, but we also need to assess the controls that are in place here at the city, primarily related to financial reporting, but we look at the controls to help us plan the audit and help us to determine how we're going to conduct the audit. However, when we're doing the audit and we saw, for instance, a process that we felt wasn't, that there was a weakness in it that might affect financial reporting, that there was an internal control in place that was not going to effectively detect errors or safeguard assets. If that happened, not only would it impact the way we conduct the audit, but we would also need to we would also be required to communicate that to you as members of the governing board. That's called, in the SAS 115 letter, they're called reportable conditions. I'm happy to say, as in last year, that there are no reportable conditions. So that basically is kind of like an unmodified opinion. It's not an opinion, but it means, things look good. And there's nothing came to our attention that we needed to report to you. The other audit communication letter is really designed as our way of communicating with you. This is a great forum that I can come and speak with you and present to you, and if you had any questions, you could ask me. But to tell you the truth, not all my clients invite me to these committees. Not all my clients have this committee, and out of all in California, our firm is probably the number one firm that audits cities. I'd say a third of my clients actually invite me to come and engage in this kind of a committee, which is great. But, for those that I don't get to meet with, they will have at least the auditor's communication letter, which you also got a copy of. So in there, not only do we talk about, the current significant accounting pronouncements that have been implemented this year, as Mr. Sewell had mentioned, things like that. A lot of that is talking about the new pronouncements or the pronouncements that are around the corner. But if during the course of the audit, for instance, we had significant disagreements with management, or there were difficulties during the audit, we were actually required to report that in there so that you would see it. But I'm here to tell you that we didn't have that. Yeah, which is actually even better, when you get to do it face to face. But that's the reason and the intent of the auditor's communication letter. So what the city of Santa Barbara has done for many years is, even though the CAFR is required by state charter, they've gone an extra step and made sure that it qualifies for the government finance officers Association's award for excellence in financial reporting. So there's just a lot of T's to cross and I's to dot. Just a lot. There's a lot, a lot of requirements that we need to abide by. And so for this last year, the city obtained that award, and the intent is to apply for that again. And so that's kind of further assurance that you would know that the format of the financials are those prescribed by the GFOA, and because some cities don't do the CAFR, they just do the financial section, and you won't have the statistical section or the transmittal letter. But this is the prescribed format for a comprehensive financial report. So that even gives you further, I think, comfort on that, of a job well done. Yeah. So in summary, we've been engaged, LSL's been engaged to perform a financial audit. And like I said, it's really basically another set of eyes to make sure that the amounts in this document are materially correct. We've issued an unmodified opinion, which is what you want. The two letters are basically pretty standard in format. Nothing came to our attention that we felt like we needed to report to you above and beyond the standard requirements. Like Mr. Sewell mentioned, I want to use this opportunity to thank the Finance Department, Mr. Samario, and the whole staff. 7 years. That went flying by. But the city's been top-notch, very diligent in wanting to do things the right way. Been a pleasure to work with, and it was another good year. And thank you for inviting me here. And I'm here to answer any questions if you might have any.
Well, thank you for coming all this way and for your kind comments about our staff and your careful work looking over the city's finances. It's important to the public and the residents to know that, number one, our staff's doing a great job and a transparent job and representing the financial facts of the city well and carefully, and it's great and comforting to know that you have put your independent look at that as well. And your team has spent time and carefully reviewed these statements. It shows that everybody involved in the process is very careful and wants to achieve the highest standard of transparency that we can, and that's important to the public, and that's the reason for having the Finance Committee and the reason for meeting and talking about these things. So thank you all.
No, thank you.
Councilmember Friedman?
I don't have any questions. I think it was a very thorough report, and you answered my few questions earlier. But I too want to echo Councilmember Hart's appreciation to our staff and to LSL for all you've done over the past 7 years. And I think it's showing that this is a certified report and the highest standards. It gets into the seriousness that we take and the planning that we put for our financials. So I just want to thank everybody for having this document available for the public, and it helps us as policy and makers up here to prioritize and also look at our own financials and have the confidence that they're correct. So just want to thank everybody involved in this document. It's very thorough and a lot of hours I can see from it. So thank you.
Mr. Samario, is there anything else you wanted to add?
Yeah, I just want to thank LS&L, Rich Kikuchi, for the last 7 years. They've done a great job for us. I think the value that I've at least personally have gotten from their work is that they have done better than other firms in the past in getting into the details of how we do things, in particular our internal control systems and procedures, which to me are really important because for their purposes, it's the way for them to assess risk and determine how much extra work they need to do at the back end. A client that has poor internal controls, they're still going to get audited. It just means they're going to spend much more time and effort at the back end to make sure that the numbers are correct for them to put their name on it. But they've been able to help us tweak our procedures and our internal controls. But I think it's fair to say that our internal control systems, and more importantly, I think our internal control environment, which starts with Paul, the city administrator, with me, and council, it encourages and promotes the idea of ensuring that our procedures are in place to reduce the risk of improprieties or misstated reports, whether even it can be the monthly reports to send to council, but more importantly, this CAFR. So I really appreciate their help in getting us to tweak that and refine that to where we have a really good system. There's no guarantee, because we can't control all the procedures out throughout the organization, but I feel really good that what we do in the finance department is good, and it ensures it reduces the likelihood of anything going wrong. But anyway, I wanted to thank Rich for all his work in the last 7 years.
Thank you.
Well, thank you all again for all this great work. It is available to the public on the city's website now, and folks can take a look at this. It's actually pretty clear in its text and its explanations of all the items, and it's an extremely useful document. It really talks deeply about the city's financial situation, which is in pretty darn good shape, I must say. So that's really the bottom line to the public and to us as decision makers, and it's a real credit to you, all of your work collaboratively. It's great to have your perspective as from statewide perspective, looking at other cities, and taking that information, applying it to our specific circumstances, just makes us that much better at it. So appreciate your work for 7 years as well. Yes, Councilmember Friedman.
So I'm going to make a motion to accept the financial report and forward to council for recommending.
Motion's been made and seconded. All those in favor say aye.
Aye.
Aye. Opposed and abstained. Matter carries unanimously, and our business is concluded. We are adjourned. Thank you very
Thank
much.
you.